Hello all, this is Chad Stayskull, President of Eagle Wealth Management with our Educational Economic Update for March 2017. In this month's video, I'm going to be covering some of the major headlines that influenced markets in February and how it could affect you as an investor. February was a month filled with record highs in the domestic stock markets. The S&P 500, NASDAQ, and Dow all hit a number of new highs last month. In fact, the Dow reached 20,000 for the first time ever in January, and then continued on to reach 21,000 only 24 short trading days later. Seeing stocks rise like this can be an exciting experience, but I want to caution you, do not get caught up in the euphoria. Just as emotion has no place in investing when the markets are volatile and challenging, the same rule applies when markets are growing. So, let's dive deeper and review some of the fundamental data we learned in February to better understand where the economy stands. On the labor front, last month gave us somewhat mixed data. We received the January jobs report. It showed the economy added far more jobs than experts predicted and continued its 76th straight month of growth. But on the other hand, hourly earnings and labor force participation each increased by only a small margin. While unemployment was also up slightly as more people entered the workforce again, ultimately, the job data released in February indicated that the labor market is growing, but the pace is still not what many experts would expect. Another area where we saw modest growth was in the revised GDP numbers for the fourth quarter of 2016. Each quarter, the Bureau of Economic Analysts calculates the U.S. gross domestic product, which is the total dollar value of everything that people and businesses produce during that period. This measurement is a critical indicator of our economy's health, so investors and financial analysts watch its changes very closely. And because the Bureau receives updated data after a quarter ends, they release 3 GDP numbers over the course of 3 months: the advance, the preliminary, and the final. And in February, we received the second, or preliminary, reading of GDP for the fourth quarter 2016. Consensus was that the reading would increase to 2.1% from the 1.9% growth in January's advance report. But in reality, the reading didn't change and stayed at 1.9%. Rather than indicating that the economy is slowing down, however, just one aspect of GDP contributed the most to the decreased growth: lower net exports at the end of 2016. Trade is an integral part of our economy, so maintaining a healthy trade balance is key. As the political environment evolves, changes to trade deals could affect this balance and, as a result, our GDP. For now, no one can say what new policies may be on the horizon or if markets will continue to reach even greater heights. So, we will continue to analyze the data and search for the most thorough view of our economic standing. This perspective is the foundation of our support, and we're happy to help you find a clearer perspective amid all the hype. So that's it for this month's Educational Economic Update. Once again, this is Chad Stayskull with Eagle Wealth Management signing off for the month of March 2017. Please remember, nothing we talk about here is a recommendation. And if you'd like to discuss your personal financial situation, please give us a call. 541-330-0220. We're happy to talk. Thank you.